show, and he is a real estate investor. He's also the author of Financial Freedom with Real Estate Investing, and he's also the host of the Financial Freedom with Real Estate Investing podcast and columnist. And so his passion is helping people become financially free in 1 to 3 years by investing in apartment building deals and raising money. And he controls multifamily real estate. And today's talk is going to be all about his work in real estate, the real estate market, and I'm really happy to have him on the show. So, Mike, welcome.
Chris, great to be here.
Yeah, briefly introduce yourself and we'll dive into the questions.
You did a fabulous job, Chris, introducing myself. What else can I tell you? How far back in time you want me to go?
Yeah, how did you get into real estate? What made you go into real estate?
Yeah, so a lot of other people, was brought up to go to school, get good grades, get a good job with benefits, and that's what I did. I got into computer science. I have a master's in computer science, and I joined a software startup in '97. It was a company called Web Methods, which 3 years later went public. At the time, was the biggest software IPO in the history, and it put a bunch of money in my pocket, which was so cool. And then I read 5 years later, I read Rich Dad Poor Dad in 2005, and it threw me for a major loop. I was confused because I thought I was a smart guy, and I had no idea about passive income, financial freedom, anything like that. So after 3 months, I came home and I told my wife I'd quit my job. And she goes, "Well, what's the plan, Michael?" I said, "Well, I don't have one, but don't worry, we have a bunch of money in the bank." And so my goal was to just learn everything about how money works. So I took a whole bunch of seminars. I traded stocks and options for about 18 months. I flipped a couple houses. I had a rental. But my big idea was to get into the restaurant franchise business. I mean, that's clearly what you would have done also. And it went well for a couple of years. I had a total of about 8 restaurants, 6 at any given time, until the recession hit. And the recession changed everything. It was a high-end gourmet pizza chain, and the recession changed everything. Revenue went down. I started losing money. I had to let my guy go that was running the whole thing. It was set up as a passive investment. And now I'm running 6 restaurants myself. I tried to dig myself out with real estate by flipping houses. We flipped 3,000 houses over the next 3 or 4 years, first by using hard money, and then I was borrowing money. And in 2011, I got into my first apartment building, a bit by accident. One of my wholesalers brought it to me, and it was a nightmare. I immediately regretted getting into apartments. Long story, but in about 18 months, it quieted down, and then started sending me mailbox money. And that's when the light bulb went off. I was like, my gosh, this house flipping stuff isn't very passive. It's a lot of work. And this apartment thing, and now that it's quiet and boring, was sending me mailbox money. And that's when I started to shift my thinking from single family house investing to apartments, and started blogging about it and started creating courses and things of that nature. Today, we're one of the leading authorities in helping people scale their real estate portfolio by getting into apartments. And so that's my long story. I kind of consider myself the crash test dummy of financial freedom. Tried a bunch of stuff, and now I'm convinced that really only one thing works, though you've had several things work for you because you have a bunch of books on various different things that worked.
Yeah. Yeah, the more I talk to real estate investors, the more it's one of the kind of the safe havens. And what's interesting is you alluded to this idea of flipping homes or landlording, and you have this concept, the hard truth, and you talk about it's unlikely to quit your job with single family and small multifamily deals. So elaborate on that.
Yeah, it's been my experience. Also, many other people typically follow a path where they start doing some flips or some rentals, and they can't scale it. If I want to do, most people can handle one flip at a time, right? 6 months a piece, 2 flips a year, you make $100,000. But how do I 10x that? Very difficult to do. Well, let's talk about rentals, right? Rentals, if I'm lucky, I can get each rental to cash flow $200 a month. But if I want $10,000 in passive income, I need 50 houses, right? And so scaling that seems to be very difficult. And most people kind of scratch their heads, go, what in the world? What is Robert Kiyosaki talking about? Passive income, it can't be done. And then what they do is they quietly shift to multifamily. Within a year or so, they literally quit their job. And it's the same phenomenon over and over again. And so my message to the millions is you cannot become financially free with single family house investing. There's a very small number of people who can do it. But on the other hand, people who do get into multifamily, literally within a year, are financially free because of the economics of syndications. And you don't need 5 or 10 years of real estate investing experience. You don't need millions in the bank because you use other people's money. And you can learn all these things literally within 30 to 60 days. And so to me, in the real estate space, it is the most powerful strategy to achieve financial freedom.
Yeah, interesting. And the other question I have for you is, what are your thoughts about the current real estate market? Obviously, last year, a lot of people were struggling with these high interest rates, and now we got a new president, and kind of what do you see the real estate market in 2025?
You got to separate two types of people: people who have owned real estate in the last 2 years, and people who have not, who are looking to get into it. If you don't own multi real estate, and you don't know what Chris is talking about right now, don't worry about it, because it's not your problem right now at all. It is true that some investors did struggle the last 2 years because we were using something called floating rate debt on projects with heavy construction. It's really the only way to do that. And because of the rise in interest rates, those loans became very problematic. Again, if you don't have one of these loans, it's completely irrelevant, because what's happening now is now prices are down because of the interest rates, increase in capital costs. So the prices have come down. But the other thing that's come down is the risk. And this is something that people don't understand. They look at the returns, they never look at the risk to get those returns. It's called risk adjusted return. Well, 2.5 years ago, you could argue that in the multifamily space, which is relatively less riskier than other things you could do, right? But within that small spectrum, 2.5 years ago was relatively high on the risk spectrum, because the prognosis for interest rates was up. Everybody knew interest rates, because it was basically at zero, right? And loan to value, the leverage was very high. Now it's completely different. Now the prognosis is equal to or lower interest rates, and the leverage that we can get is very low, right? Very low. So on the risk spectrum, within like 18 months, it's gone from one market cycle to the next. What I'm saying right now is the way that we're buying apartments now is either with fixed rate debt, or if we are using floating rate debt, then we're buying like 5-year rate caps on it, which basically makes it appear like a fixed rate loan. And we're getting very low leverage, and interest rates are going to be equal to or down, and prices are therefore likely to go up. So the outlook is totally different now than it was 2.5 years ago.
Mhm. Interesting. And talk about this era of, because a lot of millennials and Gen Z, they're getting priced out of real estate, and a lot of places are getting overvalued, and just kind of real estate has become kind of a asset and investment for, people that have capital or pools of investors, high net worth, the rich. So how do mom and pops get into real estate if single family or these small deals don't make you any money?
Yeah, it's tough, Chris. It is tough, and real estate has always been tough for people to get into. And I think the reason it's been tough is that people think that they need their own money to do things, right? So they will save themselves. They will save. Let me save, and then I will buy a rental property. Or I'll use a HELOC, right? And so it's a mindset shift when you think that you have to use your own resources to do something. It's okay. You'll just grow very slowly. You'll buy a rental property once every year, every other year, whenever you make enough money to buy a rental property. But the mindset shift really in the syndication world, and you can syndicate anything. You can syndicate a short-term rental or car wash or whatever you want, right? Is the idea of raising money, getting investors. And you said it's for the rich people. Yeah, okay, it is for the rich people, but the rich people are looking for various things. They have problems too. They have different problems maybe than the poor people. Okay, I get that. But people with money are looking for yield. Okay, they're looking for yield. They're looking for returns, but they're also looking to mitigate their risk. And they're looking for tax advantages and all those things you can get with real estate. You can't get that in the stock market. Stock market has its place. Some people argue crypto has a place in your portfolio, be that as it may. But real estate has a piece in a portfolio for different reasons. And a syndicator someone will connect that person with real estate so that that person gets the benefits of real estate, but don't have to do the work themselves. A lot of people will invest in a turnkey in Memphis somewhere. Great. Until the tenant doesn't stops paying, or the property manager flakes out, and now they're running a house somewhere across the country. That's not passive either, right? With multifamily, you typically put a professional property manager in place, and if they don't work out, you got 10 others behind him, and it makes it much more passive in that sense. So what I'm saying is there is money out there looking for cash flow, appreciation, and tax benefits. And you as a real estate investor can connect those people and educate them and put them into real estate that they wouldn't otherwise do. Doctors are a perfect example of this. They're the perfect person to put into real estate.
Yeah. Yeah, doctors, lawyers, dentists, engineers, just, people
Sure.
looking. The other question is, because you mentioned this concept of risk, and there's a new risk in real estate, and that is climate risk. And so, before because I've been investing in real estate since 1999, and this climate risk wasn't as big of a deal until after COVID. And now we got freeze, we got brutal summers, we have, cities can't provide basic services like water, internet, very basic things. And and then now insurance will not cover some places. So how is an investor to think about this in real estate as an investment?
Yeah, you exactly right. You have to assess the risk, and location is one of those things to look at. And this is why the other thing with legislation, how pro tenant, for example, the state is. And there's various reasons we don't invest in California, New York, or Washington D.C. or Oregon or any of those states for various different reasons, and a lot of them converge in some of those places I just mentioned. Right. So also Florida is a little problem now with all the hurricanes. I love Florida, great growing. It's business friendly, but man, if you get hammered with hurricanes all the time, you can't insure your property more. Well, maybe that's off the list now, right? And so there are still plenty of places in the country to invest. However, they're going to be in the southeast and toward the middle of the country, Midwest perhaps, but don't expect necessarily to buy property in your backyard, right? I mean, so typically when we teach people, I assume that you're going to have to hop on a plane.
Yeah. So the next question is, because you mentioned syndications, and so talk about raising your first million to scale with multifamily real estate.
Yeah, so there's two ways to raise money, right? One is to actually raise it yourself. Everybody needs to learn the art of raising money. And some people find it easier, some people find it harder. A lot of people say, no, I can't raise money because I've never done it before. And there's a comfort zone issue. But again, within 30 days, you know how to raise money, you know how to talk to people, you know how to get referrals, and you practice this and it actually becomes easier. So you should always raise money yourself. But again, there's going to be certain people that they're not outgoing people. They don't really like hearing no from people. But most those people, we call them deal finders. They're maybe a little bit more better with numbers, and they're much more likely to talk to brokers and analyze deals, but not so much raising capital. The other is the capital raiser, right? From a personality perspective, they're more extroverted. Maybe they have some kind of sales background, but they're not really that numbers oriented or detail oriented. So they're much more better to become a capital raiser. So there's two ways to raise capital syndication. One is directly, as I just mentioned, which is much easier than people think. Honestly, 30 days, you're like, oh my gosh, now you just got to practice it. But the other way is by partnering with people. So one thing that's not typical in a single family house investing is joint ventures, because you don't really need them. But in the syndication, if you don't joint venture, it's a disadvantage. So typically a deal finder will find a deal. Let's say it's a $4 million deal. And I'm like, I need $1 million. I can't raise $1 million, but if I bust my butt, maybe I can raise, 200,000. Like I'm just gonna bust my butt $200,000. I'm still $800,000 short. But the counterpart is a capital raiser, and a capital raiser can't find deals because they don't really like deals and numbers, but they have a network and they're out talking to people and they're much better at raising capital. So you partner with them for the 800,000, and now they form close to a 50-50 partnership in that deal. And those deals are extremely lucrative because of the economics. There's something called an acquisition fee, which you get paid at 3%. So $4 million deal, you're splitting $120,000 acquisition fee. That's amazing. That's wild. But then you also get asset management fees and cash flow distributions and a profit at the end, which is why the syndication model is so lucrative and so scalable. So really, to answer your question, to raise that first $1 million, learn how to raise money. Okay, and if you're more of a deal finder, you're not going to raise $1 million the first try, but that's why you need to be in some kind of network that has a combination of deal finders and capital raisers. Then you can do it fairly easily.
Interesting. And why is there less competition for buildings with 50 units or less? And how can people listening to this capitalize on it?
Yeah, that's a good point. I think once you get above 50, you start to compete more against some of the larger companies, like for example us, right? So you're going to compete with
Mm.
people with a lot bigger track record, and they're gonna might kick your butt a little bit, right? Because they're more competitive. And then we start competing with more institutional investors when it gets above, say, 150 units or 200 units, right? So we have a disadvantage also. And so I think this, to me, the sweet spot for the first deal is probably around 30 or 50. The smaller deals, again, not so meaningful from a financial standpoint, right? Because you can go out and buy a duplex tomorrow, right? But it's not really going to move the needle for you financially, right? So you want to find that sweet spot between something that's too small and something that's too big.
Yeah. Yeah. I always love. So, kind of another lingering question on my mind is, after COVID and we got remote work and work from home, and the commercial has really, and like in downtown Seattle, a lot of places shut down. And where do you see kind of the like commercial and like self storage? And I heard like AI data centers are gaining traction. What are your thoughts?
I'm not too big of an expert on those asset classes, Chris. So I do know. I mean, as a with office, and this is the thing. These things are cyclical. A lot of things like office space used to be amazing. COVID happened, and it's no longer amazing, right? I mean, people are sitting on empty space, and now what I heard is that there's this glut of, like, for example, in New York City, this glut of commercial space sitting empty, but there's not enough demand for office space. Why is that, right? Because the employers who want their employees back, they want really nice office space, like with amenities in there, and I don't know what they want. They don't have it. So they're starting to build it, believe it or not. While everything's empty, they're building like class A, nice, actual with gyms and all that stuff in it, right? That's wild. That's wild as well. Self-storage, I do like self-storage. Self-storage, it's fairly recession resistant. I do like that. So if you're a passive investor, that's maybe something to look at. I don't like it from an active one too much because you can't really hire a third-party property manager like you can with multifamily. So you kind of have to self-manage. Same thing with mobile home parks. That's one of the things I don't like about mobile home parks is that if you want to be successful, you got to self-manage. There's no way through it. And with multifamily, I don't want to do that. And so, like I said, I have options from the property management side.
Yeah.
So yeah, pros and cons. Again, you want to look at that risk adjusted return if you're a passive investor, and then from an active investor, I want to know how scalable is the strategy and how passive, right? Because I want to scale it up, but I don't want to have to work harder for it. And then I do want to look at the risk. How risky is a strategy? Because if I spend 5 years building this thing, and then all of a sudden something happens and everything's gone, that's bad. That would make me like houses in 2008. That kind of make me scratch my beard a little bit, going, my gosh, people build up vast portfolios over years and then lost everything. I mean, everything. And
Yeah.
to me, that's a questionable strategy, right? If I can do something and lose everything. And so to me, I just really study how long the asset class performed over market cycles.
Yeah. So, talk about what you do, because you wrote Financial Freedom through real estate investing, and you've got a kind of you've got a podcast as well. And so, talk about how people can learn more about you, your resources, and what you offer to listeners of the show.
Yeah, you just mentioned a couple great ones, the podcast and the book, Financial Freedom with Real Estate Investing. If you're watching this right now, you want the kind of the cliff notes of the book, because it's 250 pages long. Who's the time for that? There's a free course that I created called Apartments 101. And it's a great introduction if you want to be an active investor and you actually want to do this yourself as the entrepreneur. And that is at apartments101.co. So it's apartments101.co. And if you're more of a passive type investor, then our investment firm is called Nighthawk Equity, nighthawkequity.com. And there's also a free mini course that you can learn about real estate syndications. So you can opt into that. So both ways lead to financial freedom, Chris. It depends a little bit on where you are and what you're looking for.
Yeah. Yeah, as a mentor of mine told me, he's like, the ultra wealthy and the rich, they invest in assets, always invest in assets. And so that's helped me throughout my entire career. And so thanks so much for coming onto the podcast, and keep up the great work, and really enjoyed talking with you.
Chris, really delighted to be here. Thanks so much.